My name is Mark Mitchell, and I'm a mortgage broker in London, Ontario. With the spring market upon us and the housing market obviously heating up, I've been getting a lot of messages lately from new clients looking to get in on the real estate market, and a lot of them are first-time home buyers trying to find out as much information as they can. This is great news, as there's a lot of information out there, and buying your first home can be daunting. It's not always clear what incentives are available and what the process looks like. So I wanted to go over in this video the incentives that are available to you from the federal and provincial governments, the financial incentives available to first-time homebuyers. So you'll kind of get an idea of the help that is available to you. And we'll also go over some of the minimum requirements to get a mortgage in Ontario. Going through such things such as your income, your down payment requirements, as well as credit requirements, as these are often questions I get from first-time home buyers. So in terms of what's available to you to help you buy your first house, we can kind of split that into three sections. So the first being the Land Transfer Tax Refund, the second being the first-time home buyer's tax credit, and the third and final being the home buyer's plan. We'll start off with the Land Transfer Tax Refund, by far the most popular incentive by our provincial government with helping first-time home buyers get into a house. Through the Land Transfer Tax Refund program, the provincial government provides refunds for those first-time home buyers from having to pay land transfer tax. The refund is limited to a maximum of $4,000 on houses valued at a maximum of $368,000. So if your house was valued at $500,000, you would just have to pay that difference between the $368,000 and the $500,000. But you'd still get your $4,000 refund and just have to pay the difference. This is excellent for first-time home buyers, as the down payment requirements with real estate getting more and more expensive are obviously fairly daunting to begin with. So every little bit from the provincial government definitely helps. Now, I'm often asked what happens if its spouse is purchasing a house and only one of them is a first-time home buyer. In that case, if there was a 50-50 split between two spouses, then the one spouse would be able to claim the first-time home buyer's tax refund, so they would get 50% of that refund. The nice thing with the land transfer tax refund is that it's refunded to you immediately right at your lawyer's office. So in most cases, it will come right off the total bill that you have to pay your lawyer when closing on the house. So it's not as though you file your taxes and then you wait for the refund. It does happen instantly. So that will help you with your overall cost of closing, or your closing costs when you're budgeting to close on your first house. Next, we have the first-time home buyer's tax credit, which is a $5,000 tax credit offered by the federal government, which can give you a refund up to $750 on the purchase of your house at tax time. So unlike the land transfer tax refund, where it's instant, this is a credit that gets put on your taxes the year that you buy your first house. And that can usually net you up to a $750 refund at tax time. So while it's not immediate refund in the same manner as the provincial program, it does still give you a little bit of extra help at tax time on the year that you bought your first house. Finally, we have the first-time homebuyer incentive. This incentive came out a few years ago, and although it had a lot of advertising by the insurers and by the federal government, it hasn't really affected the real estate market all that much and hasn't proven to be that much of a help to first-time home buyers. What it is a shared equity program between you and the government. And by shared equity, I mean when you put 5% down on an existing home, the government will match your 5% down, giving you a total of 10% down. There's been a lot of studies done, and it came out that it will add to your purchasing power by about $20,000. But, and this is the big issue, which is why I actually haven't done a purchase yet with the shared equity program with the government. Since the government's putting 5% down for you, they also own 5% of your house, essentially. So let's say you bought a house at $400,000 and you lived, and the government put down 5% with you. So you put down $20,000 and the government did another $20,000, giving you $40,000 down payment on that $400K. If you sold that house in 10 years and the house sold for, let's say, $800,000, well, the government still owns that 5% of your house. So the government would want to get 5% of that $800,000 sale. So essentially, you're starting off as a first-time homeowner with the government owning a purchase of your home. With the government owning a portion of your home. Most buyers haven't found this to be a very attractive option, especially with it only adding about $20,000 worth of purchasing power when buying your house. But with that said, say you were just an inch, a tiny bit away from getting your first house, and it was the dream house that you wanted, and you just needed, say, $10,000 more buying power. If that's the amount that's going to get you over that hill, and that's what you wanted to buy, then I could see it being as a useful option. I don't think it's a great program, and it hasn't been very much widely used, and there actually has been some suggestions on revamping the program to make it more accessible and more powerful in the future. But it's still good to note that it is a program available to help you when you're buying your first house. So now that we've gone through all of the help available to first-time home buyers, now let's go through what's expected of first-time home buyers. And by that, I mean, what are the minimum requirements to get a mortgage in Canada and in Ontario? And what are some of the general requirements when you go to buy that first home? So the best way to think about the minimum requirements to get a mortgage is by splitting it into three: capital, credit, and capacity. By capital, we mean how much money do you have to put down when buying your first house. So the minimum down payment in Canada right now is 5%. That 5% must come from your own savings or from a gift from an immediate family member. And by immediate family member, we mean mother, father, sister, or brother. So you can't take out a cash advance on your credit card and use that as a down payment. That would be considered a borrowed down payment. Further, and this does come up from time to time, lenders will ask for 90 days bank statements to show that you have accumulated the savings for your down payment. And if being gifted from a family member, they will ask for a gift letter to show that the down payment is both a gift and is non-repayable, meaning that there's no strings attached to that gift. Second, credit. So right now, the minimum credit score to get a mortgage in Canada is 600. With that said, there are a few other requirements that the lenders want to see, and more important, that the mortgage insurers want to see. First, and almost most important, is that the lenders want to see that you have two sources of revolving credit, with the keyword there being revolving. So that means credit where you can take money out and put money back on. So that would be credit cards or lines of credit. Car loans are good, and they do help your credit, but it doesn't show that it doesn't show the lenders or the insurers that you can actually manage having revolving credit, being able to make purchases, pay it back on time, etc. In addition to having those two sources of revolving credit, they all have to be in good standing. The lenders don't want to see any late payments on anything for the previous 2 years, and they don't want to see any collections for the past 2 years, with your most recent collection having been paid off at least 2 years ago. Now, as with any rule, there are small exceptions to this. So if you think you're close to those requirements, make sure you contact your mortgage broker to talk to them about the credit requirements to get a mortgage. The third C to getting a mortgage is capacity. Capacity meaning your ability to pay. So this is when we get into the income requirements to get a mortgage in Canada. So the lenders, at minimum, want to see that you have 2 years of consecutive job history and be currently employed. To prove that, we would need the last 2 years T4s, a letter of employment, and a current pay stub. And then with that, the lenders actually will call your work to double check that the pay stub and the letter of employment are accurate and that you have been there for as long as you say you have. So now that we've gone through capital, credit, and capacity, we can see that all three of these C's together formulate the minimum mortgage requirements that the lenders and the insurers want to see when getting your first home. Now, as I said before, with any rules, there are a few exceptions that are available. One of the biggest being is if you have 20% down, but you have had some credit issues, then there are some alternative lenders and some alternative rules that allow us to bypass the mortgage insurers and go with what's called a B lender. So there's multiple various options available there. Best bet is to contact your mortgage broker to discuss alternative lending availability. So we've gone through what's available to first-time home buyers and what's expected of first-time home buyers. With the hot real estate market in Canada right now, it's a good idea to get started on this early. Some people need to prepare for years in order to buy their first home, so the earlier you can get started, the better off you'll be. If you have any comments, please do list them below, and I'll try to answer anything that I can. And also, please do like and subscribe if you want to see more videos like this about Canada's real estate and the mortgage market in the future.